Assalamualaikum everyone. Our topic today is about leverage funding. This is not a simple topic for the layman. It's a bit technical. I hope that those of the viewers who are following my video here, would be patient as I go along to outline the nature of bank uh, the nature of the banking business where al-bay is applied. So the topic today is about leverage funding, that Islamic bank do not use capital fund to do or to make murabaha, or ordinary conventional bank, they do not use their capital fund to make loan. Likewise for Islamic bank, do not use their capital fund to make murabaha or to make ta'aruk. And capital funds are essentially equity fund that has a role in existing regulatory framework. And for this reason, we need to see the role of capital in Islamic banking relative to the leverage funding that is the basis of the banking business, including Islamic banking. Now, leverage funding is the use of leverage money to make murabaha. So meaning that the bank do not use their capital fund to make murabaha. Instead, they are using leverage money or borrowed money to make murabaha. In a sense that the Islamic bank issue CASA deposits or issue FD deposit to borrow money from the depositor, from which the depositor will be getting full redemption of their placement plus profit without the assumption of any risk. So this is essentially the proposition forwarded by the bank to entice depositor to place their money with the bank with full capital protection and profit set by the contract of loan between the bank and the depositor, whereby the bank is now the debtor and the depositor are now the creditors. And you will see that why is it that the bank are not using their capital fund to make murabaha? Instead, they are using leverage money or the deposit money to make murabaha. This is simply because the cost of capital or the cost of equity capital is much expensive or much higher than the loan or murabaha the bank intend to make. So for example, if the cost of equity is expected to be 15%, because equity investment does not guarantee any return or any capital protection for the higher risk taken by the investor, they should be accorded with higher return. So that is why the cost of equity is much higher than the loan rate. The loan rate, which is coming from home financing or auto financing or credit or personal financing, on average is about 8%. And when the bank uses capital fund to make loan or to make murabaha at a lower rate, the bank will always make a loss, if they do so to use capital to make murabaha or to make loan, if we are looking at conventional banking. So for example, we look at the numerical example given here. For example, if we use capital fund of 100 million, in which the cost of equity is 15% on average for many years, into banking operation, and this capital fund is used to make murabaha of 100 million at 6%, and we can see that the earning will be negative, meaning that the earning from murabaha, the revenue generated will be 6% multiplied by 100 million will be 6 million, while the cost of equity or the cost of fund that is funding the Murabaha is 15%, and that will be 15 million, and the earning will be a negative 9 million. So this kind of model is not viable at all for the banking operation. For them to use capital fund, it will be suicidal for the bank to use that strategy. So we can see that the bank, conventional bank or Islamic bank, they will instead use leverage money. Why? Because this leverage money is much cheaper than the capital fund to make loan or to make murabaha. And we can see here that if the bank uses a deposit fund such as CASA, current account, saving account, and fixed deposit, tawarruk fixed deposit, 100 million, which in general will give the depositor around 3% per annum. And this deposit fund will be used to make murabaha financing at 6%. And we can see that the earning now will be much better, where earning from the murabaha financing will be 6 million, 6% multiplied by 100 million, and the cost of deposit now is much lower than the cost of equity. So the cost of deposit is 3 million, and now the bank is in the money. So the bank is making 3 million profit when funding is coming from leverage money. So that is why we are looking at this issue of using leverage money to make murabaha or to make loan. But then the implication of doing that, would be severe, in the sense that when leverage money or money belonging to the public, or which is money not belonging to the shareholder, when this leverage money is used to make murabaha, it opens the banking business to moral hazard, as banks saw that they are not using their own money or their own capital to make murabaha, but they are using other people's money, and that's why this kind of modality is quite dangerous, because it can lead to aggressive and irresponsible behavior, where bank can extend out murabaha to their business partner, friends and family members. Most likely this can end up in default and heavy losses to the bank. So this is something that is not desirable, because there's no skin in the game, and the bank is using other people's money, and that kind of psychological thinking may lead the bank to be irresponsible and making loans without collateral, making loans without security, and that will eventually lead the banking business to heavy losses and eventual insolvency. So we do not want to see this happening, because any losses will be borne by whom? Since deposit money is guaranteed by the bank, but still when there is a big loss, the losses to the bank will only up to the amount of capital they hold, while the rest of the losses will have to be borne by the depositor, even though depositor can sue the bank to get back their money, but there is no money for them to claim, even though if they win their cases, because by then the bank are already in bankruptcy. So for this reason, bank regulators require Islamic bank to hold adequate capital against the murabaha. So meaning that instead of using capital to make loan or to make murabaha, now capital is used to support the murabaha asset against potential loss from default. So by having capital to support the murabaha asset, then this prudential regulation will help by making sure that bank have enough capital to absorb any loss when the default event occur. So of course, under this prudential regulatory framework, we will see that bank will be prudent. The bank will be careful in making loans because if they are not careful, then any losses from the loan or murabaha will have to be written off from their capital holding. So bank now will see that they have to be extra careful because losses now will have to be borne by the shareholder, and thus when there is a default, the size of the default will not be enormously high because the risk management process were employed to ensure that bank make prudent loan and safe loans to protect the business from making losses. So this is a point that is very important because many of the laymen would look at Islamic banking as a Sharia compliant banking or patuh Sharia banking by virtue of the fact that the contract of murabaha are valid, they are free from riba, they are free from gharar, they are free from gambling, there is no pork or alcohol in the transaction, and that seems to be the only evidence or requirement to ensure that bank can make profit from the leveraging business. And but so by giving this idea that bank is based on leverage, then we will see that the Islamic banking operation is much more complicated and intricate, such that we must not take lightly Sharia compliant Islamic banking. It has to go beyond the contractual nature of the transaction. So we have to see also the commercial side of the banking operation. Okay, everyone, thank you very much for your time. I'll see you again. Thank you. Assalamualaikum warahmatullah.